The United States government spent $1 trillion in interest payments last year. Not on roads, not on schools, not on defense. Just on the interest, on debt it already owes. And here's the part they don't put in the headlines. That number is now bigger than the entire defense budget, bigger than Medicare, bigger than almost anything else the government spends money on. And it's accelerating. The Federal Reserve knows this is unsustainable. The Treasury knows it. Every serious economist in the country knows it. So they're building a plan, and the way that plan works, the mechanism they're going to use to solve a $39 trillion problem will quietly reach into your savings account, your investment portfolio, your retirement fund, and reshape what your money is actually worth. Most people won't see it coming, not because it's hidden, because it's designed to be invisible. My name is Alex, and I study how money, behavior, and hidden systems quietly control people's financial lives. What I'm going to walk you through today isn't a conspiracy theory. It isn't panic content. It's mechanics, the actual mechanism the Fed is most likely to use, what it does to your purchasing power, and the one structural shift that separates people who come out ahead from everyone who doesn't. Stay with me, because the end of this video is the part that actually matters. Let's start with the number itself, $39 trillion. It's a number so large that it loses meaning immediately. So let's translate it into something real. If you spent $1 million every single day starting from the moment Julius Caesar was alive, you would not have yet spent $39 trillion. That's how large this number is. And here's what makes it structurally different from any debt problem the United States has faced before. It's not just the size, it's the speed. The U.S. crossed $10 trillion in debt in 2008. It took over 200 years to get there. It crossed $20 trillion in 2017, 9 years. It crossed $30 trillion in 2022, 5 years. It hit $39 trillion in 2024. The curve isn't linear, it's exponential, and exponential curves don't slow down on their own. They require intervention. But here's where it gets dangerous. The intervention the Fed reaches for, the tool it has used every single time debt became unmanageable in modern history, doesn't look like a tax, it doesn't look like a cut. It looks like nothing at all, until you check what your money can actually buy. There are really only a few ways a government can deal with a debt this size. Option 1. Grow the economy fast enough to outrun the debt. Possible in theory, historically rare at this scale. Option 2. Cut spending dramatically. Politically almost impossible. Every dollar of spending has a constituency that will fight to protect it. Option 3. Raise taxes enough to close the gap. Also politically toxic, and mathematically the numbers don't work at current debt levels. Which leaves option 4. Inflate it away. This is the mechanism, and it's been used by governments from Rome to Weimar Germany to the United States in the 1940s and 1970s. Here's how it works. When a government owes $39 trillion in dollars and it controls the supply of dollars, it can make each dollar slightly less worth over time. The debt stays nominally the same, but the real value of what it owes shrinks. A $1 trillion debt in 1990 dollars is very different from a $1 trillion debt in 2025 dollars. The government pays back less in real terms. The debt burden shrinks. Problem partially solved. But here's what most people miss. That mechanism doesn't just shrink the government's debt, it shrinks everything denominated in dollars, including your savings account, including your cash holdings, including any fixed income investment that doesn't keep pace with real inflation. Your money stays the same number. Its purchasing power quietly declines. You didn't lose a dollar. You lost what that dollar could buy. And that distinction between nominal wealth and real wealth is one of the most important concepts in personal finance that almost nobody understands until it's already cost them years. Here's why this works on people so effectively. The loss is invisible in real time. Human psychology is wired to respond to visible, immediate threats. A market crash is visible. Red numbers, alarming headlines, a clear signal that something is wrong. Inflation at 3, 4, 5% annually, that's a slow, quiet erosion. It doesn't trigger the same alarm bells. It doesn't feel like a loss event, but compound it over 10 years and you begin to understand what's actually happening. At 4% annual inflation, the purchasing power of a dollar halves in approximately 18 years, which means the person who keeps $100,000 in cash savings, feeling safe, feeling responsible, is actually watching it quietly become worth $50,000 in real terms without a single number on their statement changing. People don't make financial decisions logically, they make them emotionally, and an invisible threat doesn't trigger an emotional response, which is exactly why the Fed's most powerful tool and the one most damaging to ordinary savers is the one that generates the least resistance. You can't protest something you can't see happening. This is where everything changes for people who understand the mechanics and stays exactly the same for people who don't. So what specifically is the Fed's current plan? The Fed operates on a dual mandate, stable prices and maximum employment, but there's a third reality that operates underneath both of those, the implicit pressure to manage the cost of government debt. When interest rates are high, the government's borrowing costs explode. Every percentage point on a $39 trillion is roughly $390 billion in additional annual interest, which means the Fed faces a structural pressure, separate from inflation targeting, to bring rates down and keep them lower than pure inflation-fighting logic would suggest. This is called financial repression. It's documented policy strategy in which real interest rates, the rate after inflation, are kept deliberately low or negative. Savers earn less than inflation. The real value of debt shrinks. The burden transfers quietly from the government to anyone holding cash or low-yield assets. It happened in the United States from roughly 1945 to 1980 as the government managed the debt from World War II. And the conditions today, high debt, political pressure to avoid tax increases and spending cuts, a Fed under pressure to balance multiple mandates, look remarkably similar. This isn't speculation, this is the historical playbook, and it's already running. Here's the practical translation. If real interest rates are kept below inflation, meaning your savings account earns 2% while inflation runs at 4%, you are losing purchasing power every single year while your statement shows positive numbers. This is the environment the Fed's current trajectory is building towards, not because they want to harm savers, because it's the least politically painful mechanism for managing a debt load that has no clean solution. And here's where the behavior gap appears. The people who understand this dynamic shift their holdings away from cash and towards assets that historically keep pace with or outpace inflation, broadly diversified equities, real assets, inflation-protected securities. Not individual stocks, not speculation, a low-cost, broadly diversified index fund that participates in the real productive output of the economy. The risk of holding cash isn't zero. It just doesn't look like a risk because the number on the statement stays stable. The person who keeps $50,000 in a savings account for 10 years in a financial repression environment doesn't lose money on paper, but they lose years of compounding. They lose purchasing power. They lose the real return that would have been available if they'd understood what the environment was doing around them. That's not an investment loss. That's a structural tax on financial inaction, and almost nobody talks about it in those terms. So let's look at the last time this playbook ran. After World War II, the United States carried a debt-to-GDP ratio comparable to today. The government needed to reduce that burden without politically destructive tax increases or spending cuts. The Fed kept rates artificially low for decades. Inflation ran persistently above the interest rate on government bonds. Savers and fixed instruments lost real value year after year, while the debt burden shrank in real terms. By 1980, the debt-to-GDP ratio had fallen dramatically, not because the government paid it down, but because inflation and growth had eroded its real weight. The cost of that process was borne by savers who didn't understand what was happening. The people who came out ahead were the ones who held equities, real assets, and inflation-sensitive instruments throughout the period. Not because they were lucky, because they understood the mechanism and positioned accordingly. That information was available to anyone. Most people didn't use it,
not because they were intelligent, but because the threat was invisible, gradual, and never triggered the emotional alarm that would have prompted action. The same dynamic is available to understand right now, today, before the full mechanism accelerates. So what does the response actually look like? Not panic, not extreme concentration in any single asset, not a reaction driven by fear of a crisis that may or may not materialize on a predictable schedule. The response looks like this. First, reduce cash drag. Any money sitting in low-yield accounts in excess of a 6-month emergency buffer is quietly losing real value in a financial repression environment. Understanding that inaction has a cost, even when the number doesn't change, is the foundational shift. Second, broad equity exposure. Historically, equities have been the most reliable long-term hedge against inflation and currency debasement. Not individual
Stocks, not speculation, a low-cost, broadly diversified index fund that participates in the real productive output of the economy. Third, consistency over timing. The single most destructive behavior in an inflationary environment is trying to time the entry point, waiting for the right moment, while purchasing power continues to erode. The cost of waiting is not zero. It compounds against you just as reliably as returns compound for you. This isn't a complex system. It's not reserved for sophisticated investors or high-income households. It's a framework built on understanding what the environment is doing and making structural decisions that work with it instead of against it. The difference between the two outcomes isn't intelligence, it's information acted on. Conclusion. The $39 trillion debt crisis is not a future problem, it's a present condition. The mechanism to manage it is already running. The effects are already visible in purchasing power, in savings returns, in the slow, quiet erosion of what money actually buys. Most people will not change their behavior because of this, not because they don't care, because the threat is invisible, because it doesn't trigger the emotional response that visible losses trigger, because it's easier to feel safe when the number on the statement stays the same. But the people who understand the mechanics, who see the invisible tax for what it is, have a different relationship with their money. Not anxious, not panicked, structured. They hold less cash drag. They hold more productive assets. They let compound growth work for them instead of watching compound erosion work against them. And the gap between those two groups over 10, 20, 30 years is not a small difference in returns. It's the difference between a retirement that works and one that quietly falls short, between financial freedom and financial dependence, between building something real and watching something invisible take it apart piece by piece. The Fed's plan will manage the government's debt. The question is whether it manages yours too, or whether you build a structure that protects what you've built. That choice is available right now, before the mechanism fully accelerates. Wealth is not luck. It's not timing. It's not finding the right secret. It's understanding the system you're operating inside and making behavioral decisions that compound quietly in your favor over time. The difference between being stuck and being free is not income. It's behavior repeated quietly over time. If something in this video clarified a dynamic you felt but couldn't name, hit the like button. It genuinely helps this reach the people who need it. And if you want to understand exactly how to structure your investment accounts to work in this kind of environment, which assets, which accounts, and how to automate it, that video is right here. I'll see you there.